Very warm welcome to all our participants joining us today's webinar on the topic Stable Income from Indian REITs and InvITs. I am Arvind Ravindran from PMS Bazaar. Over the past few years, India's real estate and infrastructure investment landscape has undergone a quiet but powerful transformation. And at the center of it are REITs and InvITs, offering investors the unique combination of stability, regular income, and real asset-backed growth. Today's session will help us understand why these instruments deserve a place in every serious investor's portfolio and how portfolio management services can provide a more structured and transparent way to invest in them. We are delighted to have with us Mr. Rahul Jain, Head of Public Markets at ALT, who will walk us through ARIPS, ALT's pioneering PMS strategy focused on listed REITs and InvITs. He will share key insights on why investors should consider REITs and InvITs as a core part of the portfolio, how PMS adds a professional edge to managing these instruments, the key features and benefits of ARIPS, how the portfolio is managed for consistent returns, and how it compares with other asset classes in terms of income and risk-adjusted performance. Mr. Rahul is a seasoned investment professional with over 13 years of experience. His experience includes managing a $350 million fund at a single-family office in the Middle East, investing globally across asset classes. Previously, he has worked at Deutsche Bank and Standard Chartered Bank, and at ALT, Rahul heads the Public Markets Division, looking after the PMS products. He holds a B.Tech in Electrical Engineering from IIT Bombay and an MBA from IIM Lucknow, along with clearing all levels of CFA. Welcome, Rahul, and I would like to hand over the forum to you for your presentation.
Thank you, Arvind, and thank you, PMS Bazaar team. Lovely to be here. I've prepared a small deck. What I'll quickly do, I'll run through everyone through this deck. Basically talking about what we are doing on this REITs and InvITs space, and then probably we can take over questions, etc., whatever participants may have. So yeah, without further ado, I'll quickly run through this. So essentially, beginning of this month, we launched a new PMS product, which essentially focuses on listed REITs and InvITs. And why listed REITs and InvITs? Primarily because it's one avenue through which investors can have stable income, invest in real institutional grade infrastructure and real estate assets, tax efficient returns on a regular basis, along with some capital appreciation kicker over a period of time. So over here, essentially what we are looking at, we are targeting a yield of around 8 to 8.5% and a target IRR of around 13 to 15% over a course of 4 to 5 years period, which will help any investor to achieve a regular sort of income along with a capital appreciation kicker. So why this product? Essentially, like I said, it provides you with current income. Any REIT or InvIT provides on a quarterly basis distributions. On a blended basis, it will give you 8 to 9% yield, which is distributed quarterly. You can invest in institutional assets, grade A infrastructure assets like power grid and integrate InvITs, own power lines, in some cases renewable assets, renewables power generation assets as well. When we talk about REITs, Manyata Tech Park is owned by Embassy REIT, and countless other business parks are owned by Knowledge Realty Trust, Mindspace REIT, etc. Both REITs and InvITs are governed by SEBI's regulations, while PMS as well is separately governed by regulation. So anyone investing through this kind of gets benefits of both of them. I'll deep dive also a bit more later in the presentation. What is most interesting about this asset class is essentially REITs and InvITs. Otherwise, if someone has to invest in directly into an infrastructure or real estate asset, they need a very, very big ticket size. Secondly, if they need to exit, it takes a lot of time, right? A year, couple of years as well. Through REITs and InvITs, you sell it on the exchange and you get settlement the next year. So T+1 liquidity, which is extremely great for such an illiquid asset class. And why institutional investors love this? Because I mean, a lot of investors invest in equity, but when you look at these underlying, since the underlying cash flows are so strong, typically these assets don't have a lot of volatility, and also while equity markets may go up and down, they tend to be fairly uncorrelated with this. So, in fact, we did the analysis over the last 25 quarters for the REIT and InvIT index. It had a very low correlation of less than 25%, and volatility was one third lower than the equity volatility itself. So when we talk about the returns, so Nifty launched its Nifty REIT and InvIT index way back in 2019, mid 2019. So we ran through last 25 quarters of analysis since its inception, and essentially saw the returns on a total returns basis, which REIT and InvIT index gave, was almost close to what a Nifty 50 gave over the same period of time. When you see here 13% versus 13.7%. Additionally, if you look at purely yield, the yield itself was much higher than other debt-related options like FD, G-Sec index, or debt mutual funds, given that returns are over 8% as compared to debt MS, which kind of gives 7.5% return. So this product essentially gives you this hybrid sort of an advantage where you get the advantage of a bond or a debt product and a yield which is much higher than that, in addition to a capital appreciation of 4 to 5%, which is kind of similar to what the inflation which in India has been over the last 4 to 5 years. And if someone would have invested 100 rupees in Nifty 50 and REIT and InvIT index and G-Sec, so today the 100 rupees would have become 215 in REIT and InvIT index, 228 in equities, and 145 in G6. So it kind of gives you a similar return. When you look at this, you kind of also get that the returns are also a lot less volatile. And like I said, it gives you access to extremely high quality real estate. Today, in India, you have around 8.5 million square feet of office, 850 million square feet of office space, grade A office space. The 5 REITs which are listed today together have 165 million square feet of area under management. Another 10 million is primarily of Nexus REIT, which is basically grade A high quality malls. If we talk about how this fares globally, approximately 2% of the market cap, 2% of the equity market cap is in REITs space. While if we talk about India specifically, its market cap is just 20 billion, which is just 0.5% of the $4 trillion plus market cap, which the equity markets combined. So this kind of shows that the amount of runway and the market cap, which it can very easily go. In fact, while we keep on hearing about new assets which are getting added to the existing REITs, we do expect a couple of more REITs as well, especially Bagmani and Panchini in terms of which may come over the next 4 to 6 quarters as well. On the InvIT side, primarily high quality infrastructure assets, we currently have 6 listed InvIT with the recent Anantam Highways Trust, which kind of got listed just earlier this month itself. InvITs today have 26 across private and public. In case of InvITs, there's a private InvITs as well, which are not publicly held, or investment ticket size is much higher there, primarily for institutions. But through this PMS, you can kind of invest in these public InvITs like IRB, Indicate, Power Grid, which are backed by, again, high quality sponsors like KKR, Power Grid, etc. When we talk about the SEBI regulation, like I was mentioning, REITs and InvITs by regulation itself needs to minimum distribute 90% of the income which they are generating. In general, they have been distributing close to 100% of the income which they have, but by regulation itself, 90% is the bare minimum. To keep the risk minimum, they also cannot have more than 20% of the portfolio in under construction assets. If we look at across REITs and InvITs in general, the number of the amount of completed assets is a lot higher than 80%. In most of the cases, it's about 90%. But 80% is the bare minimum which SEBI has kept. And in terms of leverage as well, to keep the risk low, there are strict leverage limits as well. On the PMS side, as some of you already would know, you can only invest in listed securities and you can exit at any point of time. Your holdings are in your own demat account, so it kind of gives you complete visibility of what you are investing in at any point of time. And like I was mentioning about liquidity, over the course of last 6 years, 2019 was when the first REIT got listed, 2017 when the first InvITs got listed. The investor count has increased steadily to almost 5.5 lakh today. Along with that, the liquidity has also increased. Today, when we ran this analysis for last quarter, average trading volume was 127 crores, which primarily means even if someone wants to exit, let's say a 5 crore sort of a portfolio in REITs and InvITs, in a single year, they can very easily exit without much of a impact cost. So this kind of shows how it has deepened over the course of last 5 years. And in fact, over the last couple of quarters itself, I've seen this volume growing by 50-60%. So just a couple of quarters back, this average trading volume was much lower than what it was in double digits. So that the volume also is increasing steadily over the course of the last few years. And coming to the tax efficiency of this distribution. So this is something which really, along with liquidity, this really makes this asset class stand apart from any other investment which you may come across. So REITs and InvITs have a specific, under regulation, these trusts have specific advantage due to which portion of the income of which REITs and InvITs distribute become tax-free in nature. So what we did an analysis for FY25, last financial year, of REIT and InvIT index. And what we saw, approximately 60% of the income was tax-free in nature for any investor who would have invested. And 40% approximately was fell in the taxable space. And since the yield was around 8%, for a person who is falling in 30% tax bracket, essentially the post-tax return for that investor basically came at 7%. So when you compare it to, let's say, an FD, which is, let's say today, best FDs are giving you 7% of any scheduled commercial bank, post-tax, they become basically sub 5%. So you get that 2.5% sort of a post-tax yield advantage for any investor if they invest in REIT and InvITs as compared to if they are investing in a FD, etc. This is in addition to whatever capital appreciation an investor will also see over the course of the holding period. And like I was mentioning in terms of diversification, so any investor who is holding a portfolio, it becomes a very essential tool that they should allocate some portion to this asset class, primarily as a diversification tool, which helps in improving the risk-adjusted returns. If you look at the volatility, like I mentioned, it's 1/3 lower than the volatility of equity or Nifty 50 to be specific. And when we look at the beta as well, which is 0.25, which basically shows it's very less very less correlated. In fact, if we talk about the last 1 year returns since September of last year, since October 1st of last year to September end of this year, while equity has given a negative return of 3.5%, REIT and InvIT index gave more than 20% return. So this kind of shows the uncorrelation of these asset classes, because underlying effectively are fairly the same. And all of you would have heard about India being the GCC capital, global capability center. Someone staying in Bangalore, Mumbai, Gurgaon would anyways know how many employees really work for supporting global offices. And what has been interesting, while way back, 15 years back, when a lot of back office stuff used to happen in India, today, a lot of front office work, a lot of important research activities happen based out of India, and which is where the number of GCs have more than 2.5 and are projected to triple till FY28. Primarily, the main reason being the low cost operations in terms of in India. If we talk about Bangalore, it is one-fifth the cost of US tier 2 city, which is why every big Fortune 500 company has a GCC in India, be it in Bangalore or Mumbai, Hyderabad, Gurgaon, NCR, or Chennai, which are the key cities where you have a lot of GCC operations. And if you look at overall leasing space itself, GCs have become a lot more important over the course of last decade or so, where now more than one-third of the leasing is basically done by GCCs. When we talk about InvITs, of course, since Modi government coming in 2014, the focus has increased tremendously in terms of increasing power generation, transmission capacity, or roads, where outlay for roads has basically increased tremendously, and road construction also has become almost 3x over since FY15. When we talk about electricity consumption in India, it is still much lower than that of US, or for that matter, even in Europe, which primarily means, so if India has to become a middle income and developed economy by 2047, the electricity consumption needs to increase a lot. So we use our own proprietary models to build a portfolio for high quality REITs and InvITs, where we have essentially filters based on how each asset is, what's the value of each REIT. So what we end up doing, we basically, let's say, for example, we talk about Embassy REIT. Embassy REIT today has 14 office assets and a couple of hospitality assets. So given that we are very well suited in terms of valuing each and every asset, we go and look at each and every business park, look at where the leasing is happening, what sort of occupancy numbers are there, what sort of cap rates these assets are getting traded. And based on these market level data, we basically essentially assign a certain value to each and every asset, sum it up to get a final valuation for each and every asset, or for each and every REIT and InvIT, and then overlay that with the overall occupancies they are running, the lease expiries they have, how these REITs have basically over a period of time acquired asset, what sort of value accretion that those assets have brought in, how the tenant quality is, how the counterparties are. So based on that, we basically assign the entire portfolio in terms of which will be over allocated, which will be under allocated, and then build this entire portfolio of REITs and InvITs. Going slightly deeper in terms of how we are looking at achieving these target returns. So in terms, I must mention before going in detail, these are all illustrations, and of course there are no guarantees anywhere. So for a minimum 50 lakh investment, so typically 8% is sort of blended yield, which one can expect. Over a course of next 4 to 5 years, on an average, you can expect a 5% sort of appreciation in terms of how the dividend yields will grow. And then after 4 to 5 years, we can look at exiting at a lower yield, which effectively means the value of the asset will go up. And since as India is growing, the inflation is coming down, interest rates are also structurally coming down, which will basically help in reducing this yield. And because of this yield compression, we can expect 8 to 9% yield and 12 to 15% sort of IRRs over a course of 4 years. These are key terms in terms of, so we will be investing listed REITs and InvITs, annual management fee anywhere between 0.8 to 0.4%. We've kept fee fairly low because primarily we want investors to, we know that today REITs and InvITs are something which investors want to invest in, but they are not able to kind of, they don't have the expertise, or no one else is also covering REITs and InvITs that strongly, which is where we want this product to be available for everyone. And then we have kept also exit load of just up to 2 years, 2% for first year and 1% for the second year. If we talk about us all at all, we are basically a leading investment tech-led, technology-led alternative investment platform through which investors invest in institutional-grade institutional alternative assets. So we started way back in 2016. Our founders, Kunal and Hashim. So Kunal worked with Blackstone for 8 years and then set this up. Essentially, we have been working in this space since the time when REITs were also not there. We started the first fractional ownership platform in the country under the brand Property Share, which now transformed into Property Share SM REIT and Oil Capital. We bring in an experience of $3 billion. We currently manage $15 million across all our verticals of fractional ownership platform, SM REITs, PMS, and a UK warehousing platform as well. We were also rated top 20 by the Global FinTech in 2023 by CNBC. We have marquee investors in the form of Westbridge and Lightspeed at our portfolio. So I mentioned about SM REIT. So while everyone knows about the first SM REIT got listed in 2019, SEBI came up with the regulations of SM REIT regulations, which was primarily to formalize the fractional ownership platform, which we at PropShare, Oil/PropShare pioneered. So last year in March, they came up with these regulations. We were the first ones to apply and get the license in July. And then we listed this asset, the first SM REIT listing in the form of PropShare Platina, which was basically 6 floors in a building, Prestige Tech Platina on Outer Ring Road in Bangalore, which was basically valued at 353 crores. I was the one who was looking at acquiring the entire transaction. There are some of the pictures of the listing ceremony as well. Well, we also listed the second scheme. There are currently only 2 schemes which are listed, both done by our sister concern, Property Share Investment Trust. This was a listing in Mumbai, specifically in Thane, again, a 473 crore listing for approximately 4.5 lakh square feet, both giving 9% yield, 7 to 8% sort of post-tax yield for investors. Like I was mentioning, $250 million approximately we have spread across privately listed, which is fractional ownership platform, SM REIT, UK warehousing, and we have a couple of AIFs also, which is also basically rent generating commercial real estate we invested. This is our entire team. Kunal and Hashim are the co-founders. I head the listed products division. Sandeep, head of operations. Shashank assists me in my investment decisions. So that's pretty much it from our side. Happy to kind of answer any questions which you may have.
Yeah, thank you so much, Rahul, for that insightful and detailed presentation. I am sure our audience found that extremely valuable. Participants can now post their questions in the Q&A box. Let's now move on to a few questions, Rahul, to delve a little deeper before we take audience questions. Listed REITs in India have delivered steady yields but limited price appreciation so far. So what, in your view, could trigger a re-rating of this asset class in the next phase? And do you see factors like interest rate moderation or higher occupancies or new asset additions driving that shift?
Sure. So I think I would not kind of agree that there's a limited price appreciation in this asset class. So if you look at REITs, right, your first REIT of Embassy got IPO'd at 300 rupees. Today, it's trading at, let's say, 430, 440 rupees. So you are basically talking about close to 45% sort of return over 6-year period, which effectively boils down to a 6% sort of CAGR return on top of 8% yield, which it generates, right? Broadly 13, 14, 15%. So if you look at, like I mentioned in one of the slides as well, over the course of last 6.5 years, 6 years or so, 13% has been the CAGR return. So return has been fairly good. Investor needs to be cognizant of the fact that they need to invest at the right time. There has been sprouts of bouts of, there has been times when, for example, embassy in 2020 kind of went all the way above 500, someone where it was trading at sub 4% yields, right? So a person needs to be really, really need to understand how this market works, and which is where the timing becomes important, which is where players like us really help in terms of helping investors invest at the right time. From a re-rating standpoint, recent reclassification of REITs into from hybrid to equity has really helped, has basically drove the valuations also up to some extent for REITs. Over the last month or so since the notification came in, REITs have delivered anywhere around 10-12%, given which REIT you choose over that period of time. And on top of that, like you said, interest rates going down structurally really helps in driving down the cap rates and potentially giving the valuations up. And occupancies, if you look at over the last 6 quarters, 2024, finally after a great leasing of 2019, finally after the 2024, the best leasing period overall, right? So occupancies have really gone up. This year as well, last 3 quarters, first 3 quarters of this year as well has been, leasing has been through the roof. So, I mean, I think we are very, very positive about REITs as an asset class and InvITs as well, given that a lot of new InvITs are getting listed, and there are quite a few private InvITs which we see based on our market chatter, what we see getting listed over the course of next 12 to 18 months.
That's quite insightful, Rahul. And that also gave the USP of investing in REITs and InvITs through a PMS product, because timing essentially matters.
Timing becomes very, very important,
when investing in the REITs and InvITs. The one most important thing I have noticed on your presentation is that REITs and InvITs are 33% less volatile than equities and have a much lower correlation with them. So do you think their role can be a core portfolio component for long-term investors rather than just as an alternative or satellite exposure?
So ultimately, look at how this gets situated, how this can get allocated in a portfolio, right? Let's say there's a retiree who's looking at a passive income, whose portfolio is anywhere between 60 to 80% in debt, right? They can very easily allocate 10 to 20% of the entire portfolio into REITs and InvITs, because it will give them a post-tax higher return. Then, and also over a period of time, this 100 rupees invested also appreciates to, let's say, 105, 110 on a annually basis, which makes it inflation index. As his expenses grow, it will also grow. For an investor who's in wealth accumulation mode, let's say 35, 40 years old, who may not have any use for these expenses, right? He can simply redeploy the same yield and the portfolio can grow. So basically any debt exposure which anyone wants to basically to smoothen the return profile, portion of that can very easily be allocated to this without losing the main characteristic, which is basically to smoothen the return profile for overall portfolio, and delivering a slightly higher return as opposed to a much lower post-tax returns for a debt investment.
Got it. Interesting, Rahul. Now, another area that's on top of investors' mind is tax efficiency. So how does ARIPS provide a tax-efficient option for investors, and how does the taxation framework differ for NRI investors, especially in terms of dividend, interest, and capital gains components of the distribution, and how it works out for them when investing through your product?
Sure. So I'll probably answer the PMS question first. The beauty of PMS is essentially investor has all the holdings in their account, right? So it's whether in case of fund where everything is done via NAV, etc., it's essentially like holding all the securities in their account and they are owning it, right? So distribution doesn't really, or rather taxation doesn't really differ from that standpoint, right? It's clear pass through. There is no additional complication from that standpoint. When we talk about REITs and InvITs specifically, then how it works is essentially in general, there are three main components, like you mentioned: dividend, interest income, and repayment of capital. Dividend, it is tax-free in nature. There's only under certain conditions it becomes taxable, which in general is not there in case of any REITs, and with barring one small section in case of power. So practically, it's tax-free in nature for investors. Interest income, that is taxable in investors' hands as per their tax law. And then we talk about repayment of capital. That's also tax-free in the hands of investor. The only one difference is whatever capital is repaid, it's reduced from cost of acquisition when an investor is selling the units. So to give a lot more clarity, let's say someone has invested 100 rupees. In 1 year, he's received 8 rupees. And let's say repayment of capital was just 1 rupee of the 8 rupees which he received as yield. If he's selling this portfolio after 1 year and it has become, let's say, 110, instead of calculating capital gains on 110 minus 100, he will have to reduce that 1 rupee of repayment of capital. So his cost of acquisition becomes 100 minus 199. And capital gains is basically 110 minus 99 on 11 rupees. So that also is fairly tax efficient because your tax is back-ended, and that's also at 12.5% as compared to, let's say, marginal tax rate of 39% as well.
Wonderful. It's helpful, Rahul. Now, given the limited number of listed REITs and InvITs in India, a natural question many investors have is, why should they invest through the all PMS instead of buying these instruments directly in the market? So what additional edge or value does your team bring through the ARIPS strategy?
Sure. So I get this question a lot. Like I mentioned, ultimately, REITs and InvITs, the important point is to invest at the right time. Secondly, an investor, when they're investing, they should, rather than investing through us, there's no institutional coverage which one can get about REITs and InvITs. For REITs, there's still some bit of institutional coverage. For InvITs, there's next to nothing, right? So if an investor needs to invest, they should have some bit of understanding in terms of how the underlying portfolio is doing, how each of the assets are doing, how their yields will go over the course of next 12, 24 months. That is the sort of analysis which we bring in, and then based on that only curate the portfolio and then invest, right? So from basis that is, we take calls whether, let's say, you need to invest in REIT A or in REIT B, right? And then whether it's even the right time to hold cash rather than investing, or so that's essentially the value add which we provide, through which we believe that we will be able to deliver an alpha over 13, like long-term return of 13%, which REITs and InvITs have anyways given over the course of last 6 years or.
It's a great point, Rahul. Lastly, with SEBI pushing for greater retail access to REITs and InvITs, do you think investor education and liquidity are improving meaningfully?
Yeah, so I think there is a lot of effort at institutional level. SEBI also wants REITs and InvITs to become a lot more retail focused, which is where when we see regulations are also kind of easing towards the recent notification through which it became equity as well. Kind of the buzz around that also was quite high, because of which a lot of retail investors also came to know about it. When we talk about this reclassification also enables REITs to actually become part of the index as well. In fact, based on our analysis, couple of REITs qualify to become part of mid-cap index. And like I was mentioning, the liquidity 3 years back was much lower. In fact, even if I talk about 1 year back, it was much lower. Kind of, it has almost doubled 4 quarters back, the liquidity. So this clearly shows that it is catching an eye from retail investors, and that it is becoming more institutional. Lot more people know about it, but I still believe it is still a beginning, and people need to know a lot more, and that's something, a job which we also as PMS providers are providing towards, to basically educate investors in terms of the benefits, etc., of this asset class.
It's valuable insights, Rahul. I think now we can move on to the audience questions, Rahul, if you're okay.
Sure.
Yeah. Mr. Gurudas Nayak have mailed us a set of questions to ask you. So I'll list them. How safe are the REITs and InvITs investments? These investments are suitable for which type of investors, like conservative, aggressive, or risk averse? What are the likely safe rates of return on these investments? What should be an ideal exposure to these products from an overall portfolio perspective? And what is the time horizon for best results from these products?
Sure. So, in terms of the types of investors, I kind of answer that question. So, primarily a retired, someone who needs passive income, this kind of fits in fairly well from wealth accumulation standpoint. So, anyone who's investing in, let's say, any conservative investor, right, who wants, who is investing, let's say, balance fund, etc., can very easily invest in this asset class. Someone who's looking at equity and wants some portion to kind of smoothen the volatility can also invest. So primarily, it's a more debt-oriented sort of investors who need a couple of percentage of extra kicker in terms of the return, along with slight capital appreciation. Portfolio level, you can allocate, depending on the type of investor, anywhere between 10 to 25% sort of a portfolio to REIT and InvIT as an asset class overall. There were 3-4 more questions. I mean, I don't know whether I answered all of them. Happy to.
Yeah. He is asking some time horizon from this.
Yeah, so from time horizon, one should look at least 3 years of time horizon, because that's typically the time through which the entire cycle kind of at least plays out. So yeah, at least one should look at a 3-year time horizon. Somewhere in between debt and again equity, where you probably will want to invest in 8 to 10 years time, right? So.
So Nikit is asking a question: will the PMS invest in private InvITs like Cube, National Highways Authority, Anzen, etc.? And your specific view on Altius InvIT?
Sure. So I don't provide specific views on any of the REITs or InvITs. I mean, at this forum for sure. But from a private perspective, currently we are looking at the listed ones. The idea from our side also is we will be launching something probably in 6 months' time, looking at private ones as well. But for that, the minimum ticket size will be much higher, because ultimately liquidity in those cases is a lot less. Investor needs to be fairly aggressive in terms of their risk profile. This product is more suited to what we have currently on from a conservative standpoint, in which is where we have aligned the entire portfolio dynamics and kept it fairly only for listed, because ultimately, if an investor wants money, I can sell it off very quickly and deliver the funds back to the investor. So yeah.
That's good. Vijat is asking a question: why should we not buy REITs and InvITs directly? Like, he's asking a reason to not buy directly. Is there any
Sure. Like I mentioned, see, ultimately, one can directly invest in REITs and InvITs. In fact, like I said, I want everyone to be, whether through us or directly, I want them to allocate monies towards this asset class. However, one needs to be cognizant that there have been instances where REITs and InvITs, people who have invested not knowing how, let's say, a REIT and InvIT deliver returns, have ended up losing money as well. And which is where the value add which we provide, essentially, for example, InvITs, right? InvITs, a lot of investors look at the yield and then invest in InvITs. However, without realizing the fact that InvITs over a course of time have next to zero terminal value, like 15-20 years down the line, unless they acquire new assets. So to actually understand how that essentially works, and whether that InvIT is acquiring assets to kind of keep on keeping the capital value high enough for you to invest, right? An investor requires to do that research before investing. And I mean, if they can do themselves, I mean, they should invest directly. But if they can't, if they don't have time or knowledge to do that, we are there to help them in that journey.
Vijay B. Joshi is asking a question: what will be the net returns post charges?
Sure. So, like I said, let's say I'll take the midpoint, let's say around 14% sort of return you got. And you invested 5 crores, let's say 0.5% is a management fee, or 50 lakhs, 0.8% is a management fee. 13.2 will be net return post management fee. There's a 8% hurdle post which we charge 15% performance fee. On 4.2, we will charge a 15% carry, which essentially becomes around 60 basis points. So 12.5 is essentially your net return in case of 14% total return for the investors.
Understood. Ramesh Varadarajan is asking a question: can you share the current portfolio of REITs in your PMS holdings?
Correct. I'll not be at liberty to share that, but I mean, please feel free to invest with us, and we will. But yeah,
Okay.
overall, I can mention this thing for sure that we are more. Majority of the portfolio is in towards REITs and lesser towards InvITs in terms of the overall profile of the portfolio.
Yeah,
Higher
actually
weightage of REITs versus InvITs. That's what I'm.
Yeah. Actually, Dipanshu's question is on this ratio only. What's the ratio between REITs and InvITs in your PMS portfolio?
I'll give broadly. So it keeps on varying anywhere between, let's say, 2/3 to, let's say, 3/4 of the portfolio, or maybe 4/5 of the portfolio will end up being in REITs versus in REITs. So depending on the valuations, it will end up being somewhere in that ballpark rate.
Yeah. Madhusudan is asking a question: will the terminal value of InvIT be zero after 20 to 25 years? I want to understand how can someone earn 10 to 12% per annum, and here I have 2 to 3% capital appreciation per annum.
So yeah, I mean, ultimately, what I was mentioning is of each project, which within the InvIT is the way. So to give it to throw more light, right? So let's say there's a ham project, a ham road project owned by one of the let's say IRB InvIT for that matter, right? Now what will end up happening? It will have a concession of anywhere around typically 13.5, 14 years. After 14 years, that project value goes to zero because all the annuities the trust would have received and passed on back to the investor. So technically, that value goes to zero. So that gets kind of reduced from the total capital value of the InvIT. Now, for an InvIT to continue or deliver value or continue to rise in capital value, an InvIT needs to regularly acquire new assets at a value accretive basis so that the capital value actually increases and not decreases over a period of time. Which is why I said on a steady state, when no asset is being acquired, one needs to be very cognizant that how much yield they are providing versus what's actually the IRR for each project at which they are trading. So that's essentially, I mean, in any deeper, I know it will become a lot more mathematical, which I will probably leave it for another discussion. But yeah, I mean, that's on a high level what I wanted to kind of explain.
Yeah. So Paras Matia is asking a sectoral question. What is the view on IT space demand going down in few years timeline due to less workforce needed due to increase the AI productivity? Also, what is different this time that GCCs will remain here and not go back to the US?
And not go back to the US.
Okay. US,
so,
yeah.
Let me, I mean, I read, since he mentioned lesser workforce, right? Amazon announced a couple of days back it will cut down workforce by 14,000. What's the impact in India of that 14,000? less than 1,000 get impacted. While the Indian workforce is much larger in terms of the percentage of the workforce which Amazon has. The main reason being essentially Indian employees, not only India, India as a consumption center is another story at all, but as a GCC economy ecosystem in India, today, a lot of high value added things are happening in India. So 10, 15 years back, it was primarily back office, papers moving from one door to another, that sort of stuff. The tech help used to be there, the BPO used to be there. Today, if I can bet that any research report gets published abroad, it would have gone through one of the analysts within India, sitting out of India. While their name is not there on the report, but it kind of, I'm talking about financial institution. Any sort of research in terms of whatever any buy side sells, this talking about financial service, any tech, all the tech development which ends up happening via India, where there will be coders sitting out of here or engineering managers sitting out of AI. When due to AI, essentially what is required for AI to operate, the person needs to be skilled, and that's the skill sort of human capital which India has, and at a much lower cost, and which is where even the advent of the AI, etc., GCC continues to become the bigger leasing. When we talk about the leasing stock, which is getting added or rather getting leased every quarter, it continues to increase on an annual basis, on a quarterly basis, and also the leasing has been going up in spite of the fact we have been talking about layoffs for last year and advent of AI and jobs getting cut, etc. Right? So, I mean, that's why we continue to remain positive about REITs as an asset class, and AI not impacting GCCs, or rather not impacting India's growth in GCC market.
Interesting, Rahul. Rambo is asking a question. Can you elaborate on the taxation for quarterly distribution with an example? Like I see capital gains referenced separately. I'm not sure how this is different from distributions in your product.
Again, 100 rupees invested, 8 rupees was paid quarterly, 2 rupees, let's assume for simplicity, 8 rupees over a year. Let's say 4 rupees were paid as dividend, 2 rupees as interest income, 2 rupees of capital repayment. So what will end up happening? 4 rupees of dividend income, that's tax-free in your hand. 2 rupees of interest income, that will be taxed at, in simplicity, let's say 30%. So 0.6 will be paid as tax. 2 rupees of repayment capital, that will be tax-free in investor's hand and at the time of distribution itself. So out of 8 rupees, only 0.6 is the tax which he will pay. So essentially 7.4 is the return for the investor in this particular example. As opposed to, let's say, in any other, in a debt investment where 8 rupees will be received, he'll need to pay 2.4 rupees as tax, right? So now talking about repayment of capital again, do you want me to repeat the example which I gave earlier, or I mean, that's something which
yeah, I think we will provide the contact details to you, Rahul.
Sure.
Your team can reach out to them.
Yeah, great.
Sanjay Kothari is asking a question. How long have you been managing this product? I think he is asking the tenure of this product.
Sure. So we started work on this product around the beginning of this year, and we did a soft launch around 2.5 odd months back. And we opened up to the market beginning of this month. In fact, 1st October was when, and we started the deployment as well, beginning of this. Yeah.
Palagun Madali is asking a question. How can I get passive income from your PMS? Won't it reduce the IRR to less than 13%?
So when we're talking about 13% return, it includes both the regular income as well as capital appreciation. So I mean, if let's say 8% income you are getting using regularly, that will get added on in IRR. Basically, it gets remaining 5% will be capital appreciation. That's how it will work.
Kumaravelan is asking, what is the current cash position in this fund?
Sure. So currently, for the first investment, we were fully invested in terms of our timing kind of worked well. We are not for further investments. For someone who will be deploying, there probably will end up being some portion will be allocated towards cash, given that there has been quite a lot of movement over the past month or so. I mean, I'll refrain from sharing the cash allocation.
Yeah, sure. Anyhow, we will be sharing the contact details with you. Your team can reach out to them.
Oh, great.
Yeah. Prasad is asking a question. What concessions do you provide for accredited investor? Can I invest minimum amount as an accredited investor in this product?
Yeah, sure. So for accredited investors, we have kept a 25 lakh as a minimum ticket size.
Yeah, got it. I think Prasad has got his answer. Lastly, Monica Jain is asking a question. What kind of risks are associated with these products?
In terms of risk, I mean, I find this product fairly, risk is fairly low. Of course, it can go down from the standpoint where the thesis actually doesn't play out the way we are looking at. Let's say occupancies go down across assets, the distributions tend to come down, the mark-to-market renter releasing happens much slowly. Interest rates go up, in which case also the prices end up falling. So these are the sort of risks which any investor will entail. And also, if prices go up more than what we feel is the right value, in that case also there is a chance of prices falling. But like I said, if you are investing from a 3 to 4 year scenario, chances of an investor losing money are not there. I was giving an example of 500. The Embassy REIT touched 500 at one point of time, right? Even if an investor would have invested in Embassy REIT at 500, today Embassy has come to around 440 rupees, and he would have earned income of, let's say, around 22 rupees every year. He would have still been up by close to around 10-15%, which is a very low return for 6 years. But ultimately, chance of losing money is next to nothing over a 3 to 4 year scenario is what I think.
I think that brings us to the end of today's session, Rahul. The remaining questions we will share it with you so that your team can answer directly to them.
Sure.
Thank you, Rahul.
Thank you, Arvind. It was lovely to be here and answer all the questions. And thanks a lot to the entire PMS Bazaar team as well.
Yeah.
Thanks,
Thank you, Rahul, for the insightful and detailed session. Today's discussion truly helped us understand how REITs and InvITs are shaping up as one of the most stable and transparent way to invest in India's real estate and infrastructure growth story. To all our participants, thank you for joining us and for your engaging questions. We hope this session has given you a deeper perspective on how to integrate REITs and InvITs into your portfolio for both diversification and stability. Once again, thank you all.
Thanks.
Thank you, Rahul.